Do not buy a house. Do not buy a house. I repeat, do not buy a house right now. There are 10 forces stacking on top of each other in a sequence that looks almost identical to crises that have happened before. Number 10, the war in the Middle East is choking the world's oil supply as we speak. The US and Israel launched strikes on Iran in late February, and Iran retaliated by shutting down traffic through the Strait of Hormuz. That waterway handles roughly 20% of the world's oil. Let that sink in. 1/5 of the planet's energy supply flows through a single narrow choke point, and right now, it's nearly closed. Iraq and Kuwait have already started cutting production because they literally ran out of storage space. This is the biggest oil disruption since the 1970s. Brent crude, the global oil benchmark, spiked past $110 a barrel after sitting around $64 just 10 days before the conflict started. That's nearly a 70% jump. Think about that for a second. Number 9, those oil prices are bleeding into everything you buy. When oil goes up, the cost of shipping goes up. The cost of manufacturing goes up. The cost of growing your food goes up. Gas prices jumped from under $3 a gallon to about $3.48 nationally in a single week. And in California, they're already above $5. Prediction markets are giving a 63% chance gas hits $4.50 by the end of March. That means your grocery bill, your heating bill, your commute, all of it getting more expensive at the exact same time you'd be locking yourself into a 30-year mortgage. Home ownership costs way more than principal and interest. It's utilities, maintenance, insurance, property taxes, and every one of those line items goes up when energy costs spike. Number 8, inflation is about to get ugly again. The latest Consumer Price Index showed inflation at 2.4% for January. And that sounds manageable until you realize that was before oil exploded past $100. Food prices were already up over 3% year over year. Home insurance premiums in states like Florida and California jumped 20 to 30% in 2025 alone. When you factor in that rebuilding materials get more expensive with higher energy costs, those premiums have nowhere to go except higher. Sound familiar? Oil spiked to $147 a barrel in 2008. Inflation hit 5.6%, and the housing market collapsed. The pattern is repeating. Number 7, the Federal Reserve can't save you this time. The Fed is stuck. They want to cut rates to help the economy, but they can't because cutting rates with rising inflation would pour gasoline on the fire. The Fed funds rate is sitting at 3.50 to 3.75%, and traders don't expect a cut until at least July. That means mortgage rates, which currently sit right around 6% for a 30-year fixed, are staying elevated. Let me run some quick math for you. A $400,000 home at 6% means roughly $2,400 a month in just principal and interest. Add taxes and insurance, and you're looking at $3,100 or more per month. In most states, that eats over 30% of the median household income. The math is brutal. Number 6, the job market just flashed a massive warning sign. The US economy lost 92,000 jobs in February. That was supposed to be a gain. The unemployment rate ticked up to 4.4%. Healthcare, construction, leisure, hospitality all lost workers. Manufacturing has shed jobs in 13 of the last 14 months. Long-term unemployment just hit its highest level since late 2021, with the average unemployed person out of work for nearly 26 weeks. If you sign a 30-year mortgage right now and lose your job 3 months later, you're trapped. You can't easily sell in a flat market. You can't refinance into a better rate. You're just stuck making payments you can no longer afford. Number 5, the stock market is getting hammered. The S&P 500 is down about 1.5% year to date, and the Dow dropped over 1,200 points in a single session when the Iran war escalated. Global stocks lost over $3 trillion in value in just a few days. Wall Street started the year expecting 12% gains, and instead we're watching trillions vanish in real time. If your down payment money is sitting in a 401k or brokerage account, a 10 to 20% drop turns that $50,000 into $40,000 overnight. Suddenly, you don't have enough for the closing table. And here's what nobody tells you. The companies in those indexes employ millions of Americans. When stock prices tank, companies cut costs, and the first cost they cut is payroll. Number 4, layoffs are coming, and they always follow the same pattern. Companies follow stock prices. When valuations fall, hiring freezes hit first. Then layoffs follow. Young workers between 16 and 24 are already facing unemployment above 15%. The current labor market is what economists call a low hire, low fire environment, meaning companies aren't letting people go in huge waves yet, but they're also not hiring. That means no promotions, no raises, no upward mobility to offset the rising cost of everything. Committing to a 30-year mortgage in that environment is a massive gamble. Number 3, housing inventory is flooding the market. Active listings rose almost 9% in 2025, and they're climbing further in 2026. More homes sitting on the market for longer means sellers lose leverage. Prices have already gone flat nationally, growing at basically 0% last year. In 22 major cities, values are projected to decline. 3 out of 4 Americans already say housing is less affordable than ever. When sellers can't get the price they want and can't afford the carrying costs because of higher energy bills and insurance, they become forced sellers. And forced sellers accept whatever the market gives them. That flood of inventory creates a buyer's market, and buyer's markets always reward patience. Number 2, home prices could drop 10 to 20% in overheated markets. Think about that number. On a $400,000 home, a 15% drop saves you $60,000. That's years of savings. That's a completely different starting point for your family. Markets in the Northeast, the West Coast, and parts of Florida are the most vulnerable because they ran up the fastest, and they carry the highest insurance and tax burdens. The Midwest and South have more stability, but even those areas aren't immune to a national economic slowdown. Number 1, your best move right now is to wait, stack cash, and strike when the time is right. Renting gives you flexibility. You can move for a better job. You don't pay for a new roof or a busted water heater. And that down payment money sitting in a high-yield savings account earning 4 to 5% is growing while home values flatten or fall. You're literally getting paid to be patient. If you invested that same money in an index fund over the past decade, the average annual return was around 11%. Time and compound interest are on your side. I know what you're thinking. What if prices don't drop? What if I wait and miss my chance? Here's the thing. Every data point from oil to inflation to jobs to inventory is pointing in the same direction. The sequence that crashed the housing market in 2008 is unfolding again, driven by different triggers but following the exact same playbook. Sitting on cash right now puts you in the position to buy at a discount when everyone else is panicking.